Hello and welcome. Today, we're going to dive into a book that Warren Buffett himself has called by far the best book on investing ever written, and that's Benjamin Graham's The Intelligent Investor. Now, this isn't about chasing hot stocks or getting rich quick. It's about building a solid, timeless framework for financial success. So let's jump right in with the most important question Graham asks. Right off the bat, Graham throws this question at us. What really matters more? Being the smartest person in the room or having the right discipline and emotional control? The entire book really is an argument that your character, your attitude, is so much more important than your brain power when it's about getting real long-term results. All right, so where do we even begin? Well, Graham says that before you do anything else, you absolutely must understand the huge fundamental difference between investing and speculating. Graham is so specific with his language here, and it's for a good reason. For him, something is only an investment if it checks 3 boxes. First, you've done a thorough analysis. You've actually done your homework. Second, it promises safety of principal, meaning you're pretty confident you won't lose the money you put in. And third, it offers an adequate return. Notice he says adequate, not spectacular. Just a solid, satisfactory return. If you're missing even one of those, guess what? You're not investing, you're speculating. This chart just nails the difference in mindset, doesn't it? An investor is buying a piece of a business, thinking about its real underlying value. But a speculator, they're just buying a stock price, basically gambling on which way it's going to move next. Think of it like this. An investor buys an orchard for the fruit it will produce for years to come. A speculator is just betting on what the price of apples will be tomorrow morning. And here's the scary part. A lot of people who think they're investing are, by Graham's definition, actually just speculating. So if we know that speculating is just reacting to these wild, unpredictable price swings, how is an intelligent investor supposed to handle all that volatility? Well, Graham gave us probably the most famous analogy in all of finance to help us out. He wants us to meet a character he called Mr. Market. Okay, so instead of picturing the market as this big, scary, faceless thing, Graham wants us to personify it. Just imagine you're in business with this one other guy, and his name is Mr. Market. It sounds simple, but this little mental trick is incredibly powerful. So what's this business partner of yours like? Well, to put it bluntly, he's a total manic depressive. Every single day, he shows up at your door and shouts a price at you. Some days he's totally euphoric, convinced you're both going to be billionaires, and he'll offer to buy your shares for way, way more than they're worth. Then on other days, he's completely despondent, certain the world is ending, and he'll offer to sell you his shares for practically nothing. The most important thing to remember is that his prices have almost nothing to do with the actual value of the business. They're based purely on his crazy mood swings. And this quote right here is the whole lesson. In this relationship, you have all the power. You never have to trade with him. You can just shut the door and ignore his silly offers. Or, even better, you can use his moods to your advantage. Buy from him when he's panicking and everything's on sale, and maybe sell to him when he's deliriously optimistic. The only way you can possibly lose is if you let his anxiety or his giddy excitement become your own. So, what's the bottom line? It's this. Mr. Market's only job is to show up and offer you prices. That's it. Your job is to look at those prices and decide if they make any sense for you. He's there to serve you with opportunities, but he should never, ever be the one guiding your decisions. He works for you, not the other way around. Okay, so we figured out how to think about the market. Now Graham tells us to turn the spotlight inward. Because to really succeed, you've got to know yourself. Are you someone who's willing to put in a lot of time and effort, or would you rather have a simpler, more hands-off approach? Graham basically says there are 2 types of investors. First, you've got the defensive investor. Their main goal is safety and keeping things simple. They want to avoid big mistakes, and frankly, they don't want investing to feel like a second job. Then you have the enterprising investor. This person is willing to put in the extra work and research to try and get better than average returns. Now, it's so important to get this. One is not better than the other. The right choice for you depends entirely on your personality and how much time you have, not on how ambitious you are. And for that defensive investor, which, let's be honest, is most of us, Graham lays out this beautifully simple and effective game plan. It's not about finding the next Amazon. It's about building a sturdy, balanced portfolio. Buy into big, stable companies. Or better yet, just use low-cost index funds to own a piece of the whole market. The entire strategy is designed for one thing: durability and, most importantly, peace of mind. And here we are. We've arrived at the absolute cornerstone of Benjamin Graham's entire philosophy. He called it the central concept of investment.
It's a simple three-word phrase that is your ultimate protection against all the things you can't predict about the future. And it's called the margin of safety. So what on earth does that mean? Well, it's actually simple, but it's also incredibly profound. First, you do your homework and figure out what a business is really worth, what Graham calls its intrinsic value. Then, and this is the key, you only buy it when the market price is way below that value. That gap, that big discount between the real value and the price you pay, that is your margin of safety. It's your buffer, your cushion that protects you if you made a mistake or if just plain bad luck strikes. Let's look at this chart to make it super clear. Let's say you've done your research and you're confident a company is worth about $100 a share. That's its intrinsic value. Now, the margin of safety principle says you don't buy it at 95 or even 90. You wait. You wait for Mr. Market to have one of his bad days and offer it to you for, say, 60 bucks. See that big $40 gap between the value and the price? That is your margin of safety. That's your protection. So why is this the most important rule of all? It's because you're human. You are going to be wrong sometimes, the future is totally unknowable, and your calculations will never be perfect. The margin of safety is like a shock absorber for your portfolio. It makes sure that when you do make a mistake, and you will, it doesn't turn into a catastrophe. It lets you survive the bumps in the road so you can stay in the game long enough to actually win. And really, that's the final lesson. Sound investing isn't about being a genius or having some complex formula. According to the guy who taught Warren Buffett, it all boils down to this one secret. It's what separates true investing from wild speculation, it's what protects you from Mr. Market's madness, and it's what guarantees your long-term survival. So the question I want to leave you with is this. When you look at your own financial decisions, are you operating with a margin of safety?